All right. Well, happy Friday to everybody. This is Friday, July 1st. This is HPK Provident Advisors Friday Live. Every Friday at 12:30 p.m., we do a Facebook Live. I will be the co-host today. Sometimes it's me, sometimes it's one of our other planners. And of course, we're joined by Michael Kutch. Michael Kutch is our resident portfolio manager. Of course, we do a lot of our asset management in-house as opposed to hiring other firms to do it. And so Mike runs those portfolios for us. So we're going to talk to Mike a little bit about the market. They're going to have one or two planning ideas for you, then get everybody off and running for their 4th of July holiday. Now, just as a reminder, all of the things that we're talking about today, these are not specific recommendations for any individual security or asset class or a particular approach. You should really speak with your financial professional about what is best for your situation. So these are not recommendations. We don't suggest everyone run out and do all of the things. This is a discussion. We'd be certainly glad to review them for your situation. But that's important for you to understand about our videos. All right, Mike. So after a strong rebound last week, the market took a little bit of a pause on Monday. Then we saw a big reversal on Tuesday. What are you reading into this?
Yeah, I read into every move in the market. So basically, we're in a tight trading range for a couple of days and hit some resistance on the S&P 500 around the 39.10 level. We failed to break above it, and now we're kind of trending below that 38.25. So many analysts thought that the rally could persist for a few weeks or so. It was very short, but in my opinion, it signifies that the short-term trend is reversing lower. But typically, it's never a good short-term signal to see a big reversal like Tuesday, or frankly, closing near or at the lows of the day. Overall, it appears that each rally we're getting is shorter and shorter, which to me points to further downside in the near term. Right now, the markets are really in a wait-and-see period. There's unlikely to be any positive material catalyst in the next few weeks. Then all eyes are going to turn to earnings. Now, this earnings season is particularly important for a couple of reasons. We're going to get a picture of how high inflation and lower demand is affecting overall growth of these companies, their margins, and how they see the next few quarters playing out. It's even more important because of the potential it's going to have on the analysts' year-end earnings per share forecast for the total S&P 500. A big concern of mine and many other portfolio managers is that high inflation and the Fed policy have certainly affected overall demand. However, analysts have not taken down their estimates to match that. In fact, since the start of the year, earnings estimates have actually risen, if you can believe that. So what does that mean? If you're trying to gauge the overall value of the S&P 500, depending on your earnings estimates, we're pretty much near long-term fair value in the ballpark of, say, 16.5 times forward earnings. That's earnings for the next 12 months. That's the denominator of that equation. So if analysts start to cut their estimates, that causes that multiple to expand. So a market that we thought was fairly valued now appears overvalued. Now, there's certain components within the S&P 500 index that could warrant a higher multiple. Some of those include the makeup of the composite. It's a lot more growth oriented than it was, say, 20 years ago. Even though interest rates have come up, they're still relatively low in longer term historical trends. So the fair value of the market might be closer to 18 times earnings, but markets tend to overshoot in the short term. So I would imagine we'll see a reading below 16 times before we get back to an 18 times environment. With that said, I know there's been a lot of negativity out there in the market and the economy, but things are going to get better at some point. And it's important to remember that in the not too distant future, we will get a string of good economic news. And when that happens, equity markets can rally pretty rapidly. The best days in the market tend to immediately follow the worst days.
So, Mike, you don't think the market's going to zero? Whether that be the S&P 500, whether that be an aggregate bond, you don't think they're going to zero?
Nope. I don't think so.
That's good news. You had mentioned that there's some negativity in the economy and in the market. That's fascinating. I don't see it. Don't hear it. Mike, one of the things that I really like about what we're talking about today ties into what we had talked a little bit about last week, and that's the difference between technical versus fundamental analysis. And folks, if you listen in to what Mike was talking about, there was some of the technical analysis. Mike, you were talking about resistance lines, for example. And there was some of the fundamental as well. What are the earnings going to do, and what kind of valuations? And so we talked about that in a last video, the difference between those two. And you can see that Mike's incorporating each of those approaches into our money management here at HPK Provident Advisors. So all very interesting. Let's talk about what might be important for this upcoming week. Of course, we do Friday Live each Friday. We're going to have a special edition in a couple weeks that I'll mention to you here in a bit. But what's coming up this week, Mike?
First, I'm going to touch on some things that I saw in the markets and the economy this week, and then I'll go into a brief preview of what we're looking at for next week.
Perfect.
So it's been much of the same trend. Consumer sentiment continues to trend lower. Inflation's really affecting how consumers are spending. We had another week of hearing Powell's comments. He has pretty much kept the same messaging, but he was on the ECB panel this week with other world central bankers. So pretty much the same thing. Inflation's too high, and it's probably going to be painful to slow down growth in the United States and in those other countries. But they really made the point that if they don't do that, the effects of inflation are going to be far more painful. If those inflation estimates become unanchored, it could become very worrisome. Why that's the case? Say you're looking to purchase something in the near term or in the future. If you believe prices are going to be higher going forward, you're more likely to spend now. And that just kind of puts more upward pressure on prices. The good news is, to this point, longer-term forecasts have not risen materially. They've remained, as they called, anchored. We got the PCE number, which is the Personal Consumption Expenditure Deflator. It's a mouthful to say. That was for the month of May, and that is what the Fed really likes to look at to track inflation. It was similar to the CPI we got a few weeks ago. Core, which excludes those two components of food and energy, came in below expectations and last month's reading, so that's a good sign. However, headline, although came in slightly below expectations, was higher than last month. And that has a lot to do with energy costs and high gasoline prices feeding into that. But remember, now we're in July, so that data has a bit of a lag to it. I'm more interested to see what the CPI report will be in a few weeks from now. And hopefully that shows more signs of peaking, especially on the headline. And we hope to see the core component continue to trend lower. We also got ISM manufacturing numbers this morning. It was pretty similar to that preliminary S&P Global PMI that we talked about last week. Overall, came in lower than expectations and lower than last month. And new orders did decline into contractionary territory, which is just falling below that level of 50. But overall, the composite is still above that level. Some of the positives in it, the report did show prices paid are coming down, and the production and employment component also remains strong. So I mentioned the CPI report in a couple weeks. That's a very big one to watch. We'll get the jobs numbers next Friday, which is also, I think right now the inflation component's more important, but that's certainly something to watch. So that's pretty much all I have on the economic and market front. What do you have topic-wise for financial planning this week?
Well, a couple of things. First of all, I do want to highlight, and you'll see it scrolling on the screen right now, and we are anticipating that our Friday Live in 2 weeks from now, which will be July 15th, Friday, July 15th, we are expecting to have everything wrapped up for what we had seen for the first half of the year and kind of what we're looking at for the second half of the year. Of course, each Friday Live, we talk about current week and next week. We're going to be a little bit more in the aggregate and summarize what happened in the beginning of the year and talk about what we think might happen towards the end of the year. Mike, one of the things that I found interesting about your comments, and it was around inflation, and it's the idea maybe if consumer spending goes down a bit in the near term, of course, consumer spending is a huge part of the overall economy, but if it goes down in the near term to tame that inflation in the long term, that could be good. Is that kind of a fair summary of what you had mentioned?
Yeah, as long as market participants and the people watching the economy overall sees that peak happen, and even if it's high, as long as the pattern's trending lower, it'll keep those longer term expectations anchored. And
Right.
from a Fed standpoint, it will allow them to not go as aggressive, but they're not going to be completely pausing or a rate cut in the near term.
Okay. All right. Fair enough. Fair enough. So July 15th, take a look out for that. We might have to delay it a week depending on how the research goes and that kind of thing. Of course, what we want to do here each Friday is give you a little bit of information about the market and also talk a little bit about financial planning. And of course, this is the Friday before the 4th of July, and it's Independence Day. Thus the reason for the red, white, and blue today. So let's think briefly about what we're celebrating. We're celebrating Independence Day, independence from the British monarchy and Parliament back in 1775 through 1783, roughly the Revolutionary War. And what was the big issue? Why were the colonies saying, hey, we're kind of tired of it? Well, one of the big issues among many, one of the big issues was taxation without representation. It is the foundation of our country, right?
Kind of like inflation is for us right now, Brian?
Inflation, yes, thank you. Yes, inflation would be a form of taxation without representation, truly. Yes, I guess it is. But that's what what the founding members of this country, it came around taxes, and that is always a concern for a lot of folks. Now, when we look at most people that we're working at, a vast majority of their wealth is in one of three places. It's either in retirement accounts. It could be in real estate, whether that be their personal home or owning other real estate or a small business. And we can address each of these and kind of the taxes involved in different segments. But today I want to talk a little bit about those retirement accounts. Now, important to note, we do not give tax or legal advice. You really need to lean on your qualified tax professional, qualified legal professionals on these things. These are ideas for you. These are our observations. So we don't give tax or legal advice. But let's take a look at those retirement accounts and how you might be able to help your tax situation. Well, if you're currently working, of course, if you participate in a 401k at work or some sort of retirement plan at work, or you might be eligible for an IRA, if you do it as a traditional, you could get a tax deduction. So in immediate purposes, you can help that taxation, the founding of our country. Let's minimize these taxes. You can help by getting a deduction when the money's going in. Many of you are familiar with that. A traditional 401k, you put a bunch of money in, you don't pay taxes on it. And then it grows tax deferred. So as that growth happens, dividends, interest, and all these other things, you're not getting taxed on them. So while you're working, and now we do have taxation, we do have the representation around it, of course, but there are parts of the tax code. So really think about, for immediate purposes, on the traditional retirement, work-based retirement plans, traditional IRA, you might be able to get a deduction. There's limitations on all these things. You can call us about that. With the Roth, you don't get a deduction on the way in, but you get the tax deferral on the growth. And it is possible that in a Roth 401k or a Roth IRA that you would never have to pay taxes again. There are certain rules around how long you got to have that account, that type of thing. So that's if you're currently working. Now, how about folks that have a big old IRA, they are retired. Believe it or not, Mike, we see it all the time. There are many people that their IRA is just an annoyance to them, because at some point in your life, you've got to take money out of that IRA. And that point in your life is if you're born June 30th of 1949 or earlier, at 70 and a half years, you've got to begin what is called the required minimum distribution. This is when the government says, okay, done with the protection of the IRA being tax deferred. Now I need a little bit out each year. We can do those calculations for it. If you're born July 1st, 1949 or later, by the way, if July 1st is your birthday, happy birthday. If you're born July 1st of 1949 or later, then you need to begin taking money out of these retirement accounts at the age of 72. And that's an annoyance for a lot of people because that increases their taxable income. And for a lot of older folks, that's a pretty big chunk that the government is saying, you got to get this out. Well, what can you do? Well, one of the things you might be able to do is what's called a qualified charitable distribution. And that is a way, and there's some technical things around this. We'll work you through it. That is a way that you can actually take money out of your IRA and give it to a charity. This isn't applicable for everybody. A lot of people need money out of their IRA for living expenses, and other people say, hey, if it's going anywhere, it's going to my family. But if you're charitably inclined, if you're giving money to a charity on a regular basis and not doing it out of your IRA, and you're of one of those ages, 70 and a half, 72 or older, depending on those birth years, it might make sense to shift some of that IRA money over to the qualified charity. If you do it directly, you never see the taxes on it. It never comes to you directly. You got to do it directly to the charity. Can't receive it in hand and then send it to them. We can coordinate that for you, though. Send it directly to the charity, no taxes. Not only will that satisfy the required amount, but you can do up to $100,000 each year out of your IRA. Skip the taxes altogether if you do it the right way. Again, talk to your qualified tax professional. So just a couple ideas for those people who are currently working, those people who are not working, do not have access to a plan through work, and one idea, and there's many others, quite frankly, one idea for those folks that have big IRA and it's just become a tax burden to them, quite honestly. The other thing about that is might be helpful to manage the size of that IRA when you pass it on to others, your beneficiaries. Might be helpful in the state of Pennsylvania, pass on that IRA to beneficiaries. There's a state inheritance tax. If you whittle that down a little bit, believe it or not, give them a little more along the way and give them a little less when you're not here, might give a help on the state inheritance tax as well. Again, I need to emphasize you need to work with your qualified tax professional on that. For the qualified charitable distribution that I had mentioned to you, check out IRS publication 590-B. It will outline all the provisions of how and when and if you can do the qualified charitable distribution. You need to be beyond that required minimum distribution age, for example. But check that out. That might be helpful to you as well. So that's what we got. Mike, any other thoughts, questions, observations, things we should add?
Nope. I love the jacket though, Brian.
Well, hey, thank you. It's not a summer jacket, I got to tell you. It's pretty darn warm. It's camel hair, and it's definitely a winter jacket. It's not for these 90-degree days. Just as importantly as everything we had talked about, we wish everybody a wonderful Independence Day, 4th of July weekend. Hope you are safe, and certainly if there's any clarification, anything we can do for you, any way we can expand on these things, we'd be glad to. So everybody be safe. Really, thanks so much for joining us, and we'll talk to you next Friday, 12:30 p.m. Eastern Standard Time for HPK Provident Advisors Friday Live. Talk to you soon.
All right. Bye.